Good afternoon, everyone. This is Robert Rayburn here at Life Pro Asset Management. It is August 19th of 2024, and it's hard to believe that 2 weeks removed from that dramatic sell-off that we saw in the S&P 500 and even more cataclysmic sell-off a lot of investors experienced overseas in Japan, that we're right back to where things were in the last week of July. And a big theme around this week's update is going to really be centered around time in the market versus timing in the market, but also utilizing events like this to understand how the market is evolving, how we can use different characteristics of the interest rate market or the bond market to understand asset allocation and refine or rebalance portfolios. But the big thing we really want to stick with is really staying focused on time in the market, because there was a lot of panic that happened 2 weeks ago. And we stayed focused on the type of selling that we were seeing. It appeared and continues to appear that it was largely mechanical versus fundamental. There's a lot of things that impact the plumbing of Wall Street and some of the short-term trading activity that goes on. And a lot of times, those hiccups in the plumbing can result in some pretty scary moments for your money, right? And we're cognizant of that. We're empathetic around that, but we also try our best to coach around that. So that'll really be the focus of this week's presentation. The name this week is that recovery real? When we talk about the recovery, we're not so much talking about an economic recovery, because the economy has been good, right? There's not a lot to recover from. But we're talking about that stock market recovery we've seen over the last 2 weeks. We want to know, is this real or is this some sort of head fake? So what are the lessons on reacting to noise in the market? Those is going to be the first big thing we talk about. Number two, what does inflation suggest about the economy and about interest rates going forward? And what are those key themes that we want to focus on as a result of what we see as a slightly different interest rate environment before and after this sell-off? Now, this is a slide that we did bring up a week ago. I believe we might have brought it up 2 weeks ago, but it really is important because a lot of people did panic. A lot of people said, I knew it. Here it comes. This is the big sell-off we've been waiting for. They sold, they absorbed those losses, and before you know it, things were recovering. In fact, the bottom was really the second hour of trading on that Monday. Things had already started to recover on that Black Monday. And we did get some tremors or aftershocks from the initial sell-off, but we never revisited those lows. And that's not to say we can't have another squall next week or the week after. We are going into September. But what value are we providing to hype up the 1 week rallies or to inject fear over 1 or 2 week sell-offs if it's not backed by evidence of something bigger? And we can see the impact on client returns over time, right? So if you had invested $100,000 in the market 10 years ago, I know we went over these stats a week or two ago, but I think it's important to repeat and ingrain and indoctrinate that into those who watch our videos weekly, is your money would have grown to $462,000. But merely reacting to days like Monday from 2 Mondays ago, or 3 Mondays ago, if we think about it, just missing those 10 best days over the last 10 years. So not the 10 best days every single year, but just the 10 best days over 10 years. Your money would not have grown to 462,000, but 257,000. Missing the 30 best days, your money only grew to 151,000, and missing the 51 best days, your money would have actually shrank to $98,000. And so the message is that market returns, the distribution of daily returns is fairly concentrated, right? We see in many cases those best days in the market are clustered around the worst days of the market. It's called clustering, right? So And a good, easy way to think about it is if I throw a tennis ball off the roof of a building, the initial bounce is going to come right after it hits the ground, right at the bottom there, and then the bounce starts to fade with energy, right? Classic physics. But the initial bounce is right after you hit that low point, and the markets are no different, right? You tend to see those largest moves, those daily distributions being followed by the largest rallies, and that's why we get this impact of missing the 10 best days leads to this dramatic of a change in overall market returns over a long period of time. So really important that time in the market beats timing the market. And when we look at client portfolios, the biggest value that we can add over time is not necessarily stock picking, not necessarily which strategy you're in. It's really being able to provide a coaching overlay that encourages clients to stay in the market. If we can do that job over the next 5, 10, 20 years, we're going to do our job of helping you generate a return on your money. So that's a big message I want people to be aware of as we go through times like 2 weeks ago. So in terms of the economy, it's definitely slowing, right? We don't want to be ignorant of that fact that the economy has come off a boil, right? And it's a big reason why we saw that inflation surge from 2 years ago, from the recovery post-COVID, people rushing to spend money, having extra cash as a result of government stimulus, and then multiple rounds of fiscal stimulus that really goosed the economy beyond potential, as we call it, right? So that overflow was inflation. A good way to think about that is you leave a pot on the stove and you let it boil. That water that's overflowing, that's inflation. So the Fed, what they wanted to do was turn the temperature down a little bit on the stove and stop that overflow from the boiling water, from the boiling economy, right? And I believe the evidence is suggesting that we're close to getting there. We've seen inflation dramatically slow, but we've also seen growth slow as a result of that. So the labor market hiring has slowed, right? That's without a doubt. We've seen unemployment creep up just a little bit, but we're still seeing growth is the key. So we have the labor market slowing. Manufacturing and housing activity does remain weak. A big part of that are interest rates. Interest rates are high. It's hard to get the housing market going when you have super high interest rates. Now, on the flip side of that, over the last 2 weeks, we've actually seen unemployment claims reverse lower. Number two, retail sales were very strong, and it was robust across the board. In fact, on the Walmart earnings call, and the reason why we're talking about Walmart is a bellwether for the retail economy, the largest retailer on the planet. And the CEO was as straightforward as it gets, is that we are seeing no weakness in the consumer, and we're seeing a very strong consumer. And so that combined with consumer sentiment report that showed a rebound in overall consumer feelings, I think paints a picture of, yes, we got a slowing economy, but, and this is such a critical point, it's not a contracting economy. So in other words, a little bit of Goldilocks, right? We're slowing, inflation's coming in, and it potentially opens the door to lower interest rates. So overall, what's this mean for the market? We've had an excellent rebound in the overall S&P 500 here. We can see that we broke above this downward trend line. So 5670 was the prior peak. 5119 was your support. We bounced right off support and have broken above this downward trend line. So from a technical perspective, that's pretty good. We got to a very oversold condition. We talked about that 3 weeks ago. Things got oversold and we started to bounce. So S&P 500 reclaims that 50-day moving average, as we see right here, this blue line, this blended blue line right here. Again, a positive development. And again, these are technicals taken from Thursday. Friday, we actually had a really great reversal day in the market. We started lower, grinded the way higher to end positive for the day. So again, good action overall. We're not overbought, as you can see here. We're not overbought, but we actually do want to see things get overbought. So a function or a symptom of a healthy market, a bull market that has gone through a correction, is now going through a rebound, is to get things overbought. You want this endless amount of buying to come off the sidelines. When you get a rebound that doesn't have, that appears to be or feels like it's or looks like it's running on fumes, that's when you maybe want to use those rebounds to sort of take some money off, take some profits and move to the sidelines a little bit. But so far, so good. We've had a very strong rebound, good advanced decline ratio, as we can see here, 5.6 to 1, 6.2 to 1. Last time we saw major bottoms in the market, again, lots of clustering of those significant advanced decline ratio days. So overall, these are good signs so far. And I want to remind everyone that from the slide last week, that this does not remind us of 2007. In 2007, as we can see here, most sectors were starting to break trend to the downside and had fairly weak or weakening momentum. This time around, most sectors were seeing very wide participation in the rally, both before we had the correction and after the correction. We're seeing strong trend, long-term trend, and strong early momentum, right? In other words, strong short-term price action momentum to the upside. So again, just not a market that reminds us from a symptom standpoint of what we saw in 2007. And we don't have it this week, but credit spreads, again, don't remind us of 2007 by any stretch of the imagination. Now, it's interesting. We talked about the before, during, and after this sell-off. And, the volatility price action is very similar, right? Volatility was quite suppressed in that 15 to 16 range. Massive spike, third highest volatility spike in market history. So that volatility spike was not insignificant. Again, third highest in history, I believe 87 and one of the trading days in 2008, obviously in the fall post Lehman, was number 2, and then this was number 3. So again, fairly historic in terms of that volatility spike. But I would also point out that we're right back to where we started, right? And remember what we talked about on that really nasty day, because I believe a video went out on that day. So use volatility to your advantage, right? When you see the crowds that are panicking and are selling at any price, it's time to go shopping. Most times, right? We always add most times. You want to do your homework and make sure that there's nothing bigger going on. And if we've been negative on technology for most of the year. But what we've seen during this major sell-off is not that we suddenly want to go and buy mega cap tech, but there are some value tech names that really got hit that, hey, you know what? We can finally buy some of these names at really good valuations. And that's what we did. We actually bought a couple tech names for the first time in a while. So this is how you use these moments of weakness in the market when people are panicking to, start to go shopping. Overall, if we look at the last week, inflation, again, tilted risk on. CPI came in below expectations. That's your main inflation index that the markets look to every single month. Iran war, that idea that Iran was going to massively respond to Israel. I want to be very clear. We're not saying that won't happen. It may very well have already happened because we record this on a Friday and send it out on a Monday. So perhaps over the weekend, we see that response. But so far, that risk has been pushed out. VIX is below 20 again, the VIX term structure. In other words, we're not seeing that VIX inversion like we were 3 weeks ago, where people were paying a higher price for portfolio insurance that expires in a week versus expiring 3 months from now. When you see that, that's a classic risk off, panic mode condition in the market. And then lastly, overall, just the panic in general appears to be subsiding, right? People are taking a deep breath. Retail sales were good. Unemployment claims coming down. Earnings have largely been good. Doesn't really seem like a recession, right? Yes, there was a carry trade on wine in Japan, and yes, there was panic selling, but it seems to be mostly mechanical, right? So who were the winners outside of those who had the discipline to stay put or go shopping? Advertisers, right? People who sell advertising, like CNBC, markets in turmoil, right? I'm sure everyone who's flipped on the TV has seen this little TV ad, right? Or this TV spot. Markets in turmoil, red, right? It's an ad bonanza. That's where CNBC sees those largest spikes in terms of advertising. So that's what the media does. They sell ads. They want eyeballs. And what sells with TV? Fear. So it's just a good reminder. Don't let the television be your investment advisor. Inflation, as we said, is retreating. This is the CPI, both all items and less food and energy. All items below 3% for the first time since 2021, 3.2 when you exclude food and energy. But again, below 3 with those all items, that is a very positive thing. We got PPI. We've talked about the producer price index many times in the past. That's your pipeline inflation. So when we're trying to understand what's going to end up in the inflation number 3 months from now, we look at this PPI number, right? That's our pipeline. That's your cost of goods sold, basically, right? And so we entered deflation. Right? I think that says something. It says that the Fed is doing its job so far as it relates to correcting its error of putting too much stimulus 3 years ago, right? They made a mistake. They realized it, and they're trying to get that inflation number down. So far, so good. And so what does that lower inflation number mean? Why is it so important? What is the impact of lower inflation? Well, first of all, it leads to a gradual, it allows the Fed to shift its focus to supporting growth, right? So for the last 2 or 3 years, the big focus, what has it been? It has been on attacking inflation. How do you attack inflation? Well, you got to get that growth rate down. You got to get that simmering pot to calm down so that you don't have that water overflowing. That's been the focus. Bring down growth. Well, inflation's coming down now, so now we can shift to supporting growth. So making sure that we didn't attack and kill off inflation just to kill off the economy. Right now, we got to provide support to the economy. So what this inflation progress does is it allows the Fed to shift and start a gradual decrease in interest rates. We see that reflected in the US dollar. Now, if you remember from 2 weeks ago, one of the reasons why we weren't that concerned about the market sell-off is that we did not see panic buying in the US dollar. And this breakdown in the US dollar has continued. When you go back to real scary times like the COVID shutdown or 2008 and the global financial crisis or the inflation that followed the burst of the tech bubble, you had this massive, insatiable appetite for US dollars. Why? Because the US dollar is the ultimate safe asset. You can buy bread with US dollars in any country in the world. So if you want to understand what a safe asset is, it's not Bitcoin, it's not gold, it's US dollars. Because if during an emergency, if I got to buy bread for my kids, I can do that with US dollars in any country. China, Russia, Iran, obviously America, Canada, Europe, Africa, the continent of Africa. I can use that anywhere. You can't do that with other currencies, and you can't do that with metals, and you can't do that with digital currency. And so that's when we look at the fact that the US dollar is breaking down. I think that speaks to the fact that there was not that panic that typically would result in huge buying of US dollars. So the big takeaway for us then is a weak US dollar environment, weaker or lower interest rates as the Fed shifts from attacking inflation to supporting growth and a soft landing in the economy. So then for us, what works in a lower rate environment, right? So if we can say to ourselves, we think that we're going to avoid a recession, what do we buy in the market? And so we've seen this slide before, but what are those asset classes that typically benefit from lower rate environment? Bitcoin, small cap, regional banks, large cap banks that are not on there, but that's also can be put in there. Commercial real estate. We've seen a nice bottom in a lot of commercial real estate REITs over the last 3 to 6 months. M&A, more companies are acquiring other companies, right? Cyclicals, companies that are more economically sensitive. And it tends to be less positive for like healthcare or energy. Um, it's weird. Energy is a weird one. But right now we have a supply because we're slowing down as an economy. So we do have a bit of a supply issue, and US production has picked up. So these are the ones that tend to benefit and not benefit as much in a lower rate environment. So for us, some of the specific themes that we've been invested in: emerging markets. Why? Lower dollar funding, right? As interest rates come down, the US dollar becomes cheaper, and emerging markets rely heavily on external US dollar funding. So when that US dollar funding costs come down, emerging market growth tends to pick up. So we have positioned ourselves in some emerging markets, such as China and Southeast Asia. Now, we have rebalanced some of that, as you'll notice over the last week or so. And that's just to spread our bets a little bit further out as markets have come down, rates have come down, and it's allowed us to introduce capital into sectors that we thought were too expensive 2 or 3 months ago. So, and this is point number 2 here. Small cap cyclicals, digital assets, value tech are all key overweights now in the portfolio. So bottom line, ladies and gentlemen, that volatility storm of the past couple of weeks does illustrate the power of time in the market versus trying to time every short-term move in the market. The economy does appear to be slowing, but not contracting. And that's the difference between big returns and big losses from a historical perspective. And then lastly, lower inflation and interest rates, we believe, may act as a catalyst for stocks that have been left out of this year's market rally in the first half of the year. So that's what we got for you this week. 888-543-3776. Please call us if you have any questions or concerns. We're here to help. Please reach out to your advisor. That's what they're there for. And again, have a fantastic week. And if you have any questions, please never hesitate to reach out. Thank you again, and have a fantastic week.